Do you have to be good at math to be a good accountant? No, not at all. I mean, think about it. We've got calculators right in our pocket that requires us to put some inputs in. Our software does things automatically, whether it's Excel or Google Sheets or any type of other accounting software. Depending on how it's set up, it automatically gives us the calculations for us. But what will set you apart, whether you're an accountant or you're a small business owner just wanting to understand their financials better, is being able to do quick analysis in order to determine where do we need to focus more of our attention to. Where do we need to do some deep dives? So, for example, here are just some random, profit and loss numbers I just came up with. Now, these prior periods is for, again, a prior period, whether it was last week, last month, last quarter, last year, whatever, versus our numbers for this current period. So to illustrate this, our revenue for a prior period was 100,000, and now it's 140,000. We probably don't need a calculator to determine that's a 40% increase. Now, on the surface, that sounds great, but is it really that great? Well, again, we need context. If this is regarding, let's say, a landscaping client who serviced maybe a small county for prior period where the 100,000 was generated, but for this current period, we actually expanded into 3 counties of roughly the same size. So our potential revenue could have tripled, but if it only increased by 40%, well, how do we explain that gap? Now, some people might look at the net income from 63 going up to 71 and think, that sounds good enough for me. That's an increase, that's progress, so we're all done. But not you. You see, whether you're an accountant or not, you want to think like an accountant. If our revenue increased by 40%, our potential customer base could have been tripled. But, well, let's look at these expenses here. Expense A went from 12,000 to 14,000, which again, pretty minor jump. But look, 10% of 12,000, again, we don't need a calculator for it, would be $1,200. And the increase from expense A from prior to current was 2,000. 2,000 is obviously more than 1,200. So right off the bat, expense A grew by more than 10%. And see, we don't even know what expense A even is. I just made all these numbers up. So if expense A is some sort of like fixed administrative overhead cost, then a slight bump of 10+%, period over period, probably makes sense. But what the heck happened with expense B here? It went from 25,000 in the prior period now to more than doubled. Again, we don't need a calculator to see that 25 doubled is 50,000. Obviously, $55,000 of expenses in current period is greater than 50%. So, or 50,000, excuse me. So we know that this more than doubled. And well, depending on what expense B is, which is probably more like a direct like input cost to revenue, well, that's not sustainable. If our revenue increased by 40% and expense B more than doubled, again, what's that look like for a runway in the future? That's something we'll need to look into. And once you can explain those changes, well, that's what's going to set you apart from a calculator.